Investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities, Friday night show. I'm Mark Todd from FIIG Securities. If you have any questions about the share or bond market, feel free to pick up the phone and call us on 1300 30 34 35. The email yourmoney@skynews.com.au. Joining me on the panel tonight is Stephen Nash. He's the Dr. Stephen Nash from FIIG Securities, and Chris Alcott from Mason Stevens. They're here to answer any of your questions. Hello guys, how are you?
G'day.
We've implemented some of the bond school theory here, so we're going to have a really bond focus with the doctor, so that's going to be interesting.
Tremendous.
How's your week been?
Very good, very busy. We've seen the markets bounce back, lots of activity, so it's been very good.
There's been a bit of a sell-off in the last day. Do you have a sense that it's linked to the taper, that it's in June there was a very aggressive sell-off. Now it's much more measured. I guess that just means that it'll get very aggressive at another stage. But do you feel it's linked to the tapering talk, or?
Well, last night was more about the data out of the US, particularly relating to unemployment. So you see the currency a little bit strong, the Aussie a little bit stronger, and you saw equities come off. But still parts of the market were reasonably resilient, and we saw the likes of Santos and other stocks today up strongly off their results. So I don't think the last day is really about tapering, but certainly it's in the back of everyone's mind.
What about you, Doctor? What's your thoughts on the market?
I think it's about the outlook. I think companies reporting like Walmart indicated that they're seeing quite a soft consumer out there. The consumer's worried about the high oil price. Also, high rates are starting to have an effect on the mortgage market in the US. So there is some idea that the forward outlook is starting to be a little bit clouded. In addition, of course, we've got the debt ceiling debate, which is about to restart in September. So I think the market's starting to get set up for that.
When's the debt ceiling need to be addressed? So what part? If it starts in September, when do they need to have an answer by?
I think it's towards the end of September we'll know whether or not they're going to get a conclusion to this. It's quite an important debate. Obviously, the market's been through this before, and we're in the sequester as a result of this before, but it will be something the market's going to start to consider.
Have you started looking at the sort of the effect on investments from the political angle, from the very nasty Republican Democrat experience? Have you started to look at that?
Well, definitely, and compounding that is obviously what Bernanke's going to do and what legacy he wants to leave and how he wants to leave the shop that he and how he wants to leave QE, which he implemented in a big way. So, and who gets in is a very political,
It's a really big point, isn't it? Because Bernanke needs to make a decision very quickly as to when he goes. So if he goes in September, 6 weeks from now, or a month from now, 2 weeks from now, he has to go. If he doesn't go, October is always a very skittery month for equities. I guess my interpretation for the investors at home would be that September would be volatile regardless. Is that your interpretation?
Well, I think certainly markets are cautious, definitely. There are a number of things which need to be resolved. There's some uncertainty, markets that are at high, certainly recent highs.
Yep.
I think people need to be very, aware, not alarmed, but certainly aware of those issues.
What about you?
Look, I think, if you look at the comparison between the yield on the S&P and things like a 30-year corporate bond, say 100 basis points over the 30-year swap rate, it's getting to a level where there's going to be some sort of switching out of equities back into those bonds. There's about a 3% pickup into a senior bond as opposed to the equity. And at the moment, with what's priced into the market, that pickup is probably quite attractive, given that you're in a better position in the capital structure.
Yeah, you've got to move up and be safer. I guess the idea for me is that if I was just saying to somebody before, if I looked at September, if Bernanke doesn't do something, it's really volatile. If Bernanke does do something, it's really volatile. So you need to look past September and October and November and work out, have I got a constructive portfolio that is comfortable? Am I going to worry about it, or am I going to punt that CBA's got to get back up to 75 before I'm happy? If that's the case, that's a hard trade to make. Let's go to our first email. Our first email is from John from Melbourne, and he writes, "Hi, has the equity market run too far, or do you think there is still some value?" John from Melbourne. What's your thoughts on our equity market compared to the US? I get the US volatility. What's your thoughts on how we're going to go?
Well, I think our market, firstly, is dominated by 20 stocks. Certainly if you look at the ASX 200, all ordinaries, it's dominated 67% of the total market capitalisation is 20 stocks.
Yep.
And 40% of that is in financials, and then you've got BHP and Rio. So I think if you break that down and look at the market from that perspective, I think the banks, we saw ANZ off heavily today,
Terrible.
probably specific to them more so.
Yeah.
But I think the banks are on very high price to books. They have got an oligopoly situation domestically, so I think they're very strong businesses. But I think valuation-wise, all four of them are starting to look, if not expensive, certainly toppy. And we've had a big bounce in the Rios and the BHPs over the last 4 or 5 weeks. So I certainly think it's getting to a level where finding value is more difficult.
What about you, Doctor? How's your thoughts on that?
With the regional slowdown we've seen, particularly with China coming off, we've seen Australian equities underperform relative to US for quite a while now. I agree that the banks are fully priced. I really don't think there's much left in equity, particularly the local equity market right now.
What's the safe haven trade then? If we've just decided the equity market is looking like it's run out of air, the oxygen's very thin up at those levels. We think that the US is going to be volatile, and China we don't know about. We'll talk about China later in the show, but what's the safe haven trade? If a client comes to you and said, I want to de-risk, what would you ask him to consider?
Well, I think a couple of things. One, we've spoken a lot before about the inflation-linked space, and we think that still offers strong infrastructure sitting behind that and good relative yield, certainly with cash rate where it is. And higher credits, I think you still want to focus in higher credits. I think they're going to continue to perform well. And in the equity market, I think the use of derivative strategies, option strategies, buy and rights, those sorts of things to either lower your entry price or enhance your dividend yield.
So for the viewer at home who doesn't follow buy and right, do you want to walk through what a buy and right means, what you mean by that?
Well, it means you buy the physical stock and then you write an option over the top of that. You sell a call option.
It tend to be a call option, so you don't go and write a put option. If the broker says buy and right and he makes you write a put, you need to change brokers. What's your thoughts, mate, in terms of the conservative safe haven trade? What would you ask them to look at?
Obviously, I'd recommend looking at the inflation-linked market, but if you're looking at the exchange-traded market, particularly if you're looking at hybrids, don't look at the new issues. Look at the older issues, because the new issues we think are basically overpriced in terms of spread. The spread is too low at the moment, so we'd recommend people look at those older hybrids.
So when we're talking spread, we talk the trading margin. So yes. ANZ's come out at 3.4. Westpac's about 2.2 or whatever it's going to be. It's something like that. So we're looking at that's the trading margin, and you can see in over-the-counter business, you can see Gemworth, you can see the NAB in the sort of 280, 300, 320, 330, that sort of stuff. That becomes quite attractive. In terms of 6 months from now, how does the market look for you there? Do you know what I mean? Like we're talking about external forces being volatile, creating the problem. The Australian economy, how does it feel?
Well, I think it's under pressure. I think that's quite clear. I think we've seen the RBA cut aggressively recently. We've got a fiscal situation which is going to struggle to support growth in the economy. We've got imported inflation through a lower currency. So I think there's some real challenges ahead.
We've got the China problem. How do you see the economy at the moment?
Look, I think initially after the election we're going to get a burst of investment, depending on what goes on overseas. But assuming that nothing happens overseas, we should get some sort of burst of investment after the election. But I think the economy will settle with the need for easing becoming more apparent as we get that unemployment rate ticking up towards 6.25.
Do you get the cash rate 2.5? Where is it in for Q1 2014?
I think at the moment I'd leave it at 2.5. I really have to assess what's going on after the election in terms of that investment cycle. I think we'll get actually some economists talking about tightenings. It might sound a bit strange, but I think
Certainly
people will start talking about tightenings as we get a surge of activity after the election. But I don't think that's going to happen, and I think the economy will justify another easing.
What about you, mate? Where's the cash rate go for you?
I would say it's benign. I think flat, but I still think they may ease. They're certainly remaining dovish in their commentary, the RBA. So I wouldn't say that's not possible.
We were getting ready for the show, so I didn't see the property guys talking. But I would thought when I saw the property people talking about what's happening in the market, they seem to be saying clearance rates are at all-time highs. There's a potential, bubble. Doesn't that drive a lot of the conversations around what the RBA is thinking? Because that's a big asset for everyone, isn't it, the property market? Isn't that a concern that we go into a bubble? Are you seeing any Are you worried about that?
Well, I think to the point of a higher unemployment rate, I think that's going to be the thing that limits any financially driven or borrowing driven frenzy, because I just think with full employment that certainly could be a risk, but if you've got unemployment starting to worsen, then that could limit the extent of a property bubble.
What about you, mate, on property bubbles?
I think the RBA is in a difficult position because it's trying to stimulate the non-mining sector. It needs a bit of price appreciation in the housing market in order to stimulate the surrounding construction activity. Now, after the election, I think some of that will occur, but in other words, they've really got to accept a little bit of price appreciation. I think they're prepared to do that, but not too much. Now, if we see double-digit price rises in residential property, well, I think that we've got a problem. We're not going to see that at the moment, but the signs are there. We're looking for some elevated level of price appreciation. That's probably about it at this stage.
Okay, a little bit game on if they start doing that. Look, we'll go to a very quick break. If you have any questions, feel free to give us a call on 1300 30 34 35 and the email yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is the Doctor, Stephen Nash from FIIG, as well as Chris Alcott from Mason Stevens. They're here to answer any of your questions, so feel free to give us a call, 1300 30 34 35, and the email is yourmoney@skynews.com.au. We are going to bring back, we had a viewer who calls through or sent some emails, and Sue decided that she'd like to have a bond school. She said it made a lot of sense because everyone is very familiar through experience investing in equities. They're comfortable buying those assets, but bonds are new, and we know that only a very small percentage of the population have them. And so therefore she thought it was appropriate to have a bond school. So we've got Sue's bond school starting. And I thought the best person to bring in is a doctor. So Doctor, let's talk about, you wanted to talk about sequencing.
Okay.
And I think, and it makes a lot of sense because Mercer have been on the show about sequencing. We do see it at portfolio construction seminars. We see it all the time, and I'm not sure that people understand the ramifications. And I think Challenger has made a lot of money out of it. And it's the idea that your investment horizon, your time, your invested time is going to affect your outcome, your performance. So we have some charts that we'd like to show you first, and the doctor can talk through those charts and give us some ideas. Now, we've had a little bit of difficulty getting some of these charts up, and it's coming any second now. And here is a very interesting spaghetti western.
Okay.
Doctor, let's talk it through. Let's talk. It's over to you.
Well, what we've done here is we've gotten a strip of data from the US. It includes the S&P and a 10-year US government bond, and we've allocated 75% equities, 25% bonds, and then we've basically got the actual sequence, which is the dark blue lines, and then the light blue are the reverse sequence. So what we're trying to show here is there's a big difference between the two sequences. Now, sequencing risk can be in a variety of different sequences. Reversing the sequence is only one possible way of looking at sequencing risk.
Yep.
This is quite a simple analysis, but basically we're trying to say that there's a very large difference between those two return sequences, and that can really impact you severely, particularly, for example, with the GFC, someone retiring just before the GFC and someone retiring just after that. Very big impact on retirement savings.
So if we can go to the next chart, what we're trying to show here, and for those in the podcast you obviously can't see the chart, what we're trying to show here is the reality that as you move through your investment cycle, the more volatile the asset, the greater the sequencing risk. And if you then start to transition into more conservative assets, more consistent incomes, whether it be in the form of annuities, fixed income, cash products,
yep,
you have less volatile assets, less volatile earnings. So as you move into that retirement phase into the 60s, the idea that you can expose yourself to a 20% loss or a 50% loss, you do the math. If you lose 50% of your money and the next year you make 10%,
yep,
you're still only at 55%. And that's a long time coming back.
This is a more recent chart of just looking at the last few years, so it's a little bit clearer in terms of what the returns for the portfolio would have been. But people like Ken Henry have been very interested in this type of risk, and he emphasises that it's not just about the post-retirement, it's also about the accumulation phase. Sequencing risk can affect you at any point in the super cycle. So, you can really, by exposing yourself to a lot of volatility in the portfolio, you can really be adversely affected by a poor sequence of returns. For example, we could get a series of very negative returns in equities, and that can really damage your returns.
The simple math of it is too hard to come back. You then start going to the roulette wheel and starting to have a crack at it because you need to get back, and that's the problem, because you've assumed a certain retirement number.
Yeah.
I expect to have X amount of money, and when you've got Y, it's very hard to punt it back.
As you pull that volatility down, you tend to reduce your exposure to sequencing risk. So the idea is, how do I control this? Well, you try to get a portfolio that's much less volatile.
And as you can see on your chart, which is dynamic, so we'll try and consider different charts, so they're quite exciting for the people. I guess the key to this is duration. How do you talk to your clients about the duration they should be investing in? Because the idea here that we're talking about sequencing risk is, if I want to buy on Monday and sell on Tuesday, I've got real risk because I need a volatile response. What are you talking to clients about right now about duration?
Well,
How long should they be investing?
I think the point that you were making earlier about what is coming up with, particularly out of the US and the Fed and so forth, and the political issues, is really you need to have short duration. I mean, we saw the effect of commentary around tapering, or considering a tapering scenario, and the markets fell dramatically, spreads widened, the curve steepened aggressively, and that had a very, very negative impact in a very short period of time on portfolios. Now, the reverse could happen if they don't, but that's, as you say, a bit more of a roulette wheel discussion, where the reverse might not happen, in which case if you're long duration and the curve steepens further, that could be very detrimental.
And for those viewers at home who didn't see last week, we had Nick Bishop from Aberdeen talking about duration. So if you can imagine, the closer you are to the cash rate, that's a shorter duration.
Yes.
The further you are, if you're looking at a 30-year investment, you've got longer duration. So every time the interest rate movement or the volatility, the further out the cycle, the greater the effect it is on your investments in a positive and negative manner.
Yeah.
Doctor, let's talk about education. How do you feel that's evolving for the investor class? Do you think there's enough of it? Or do you think it's still around the idea that if we should go and have a cup of coffee and you can tell me whether I buy, palladium?
Look, I think most people are very happy with discussing equities, the trading of equities, the risk associated with that. But I think in terms of Australian investors, they're really not across the bond side of it at all. Very much under represented in that area, particularly compared to global best practice. If you look across the OECD, we have one of the lowest allocations to bonds of all those OECD countries. There's a reason for that, and that is we've had 20 years without a recession. People are used to getting quite good results from equities. At some point we're going to have a recession, and when we do, it's going to be very painful for investors. The idea is to get a much more global best practice portfolio, which means higher fixed income.
Now, speaking of education, we were going to have a very quick break, but before we do, I just wanted to show the viewers a book that we've now got. The book is the Australian Guide to Fixed Income. It's just been put out. We've put it. I have to hold it close to my chest. Those in the podcast won't see it, but it's a great book that we just put out in the last week, and we're taking to customers. So any viewers who'd like to email and talk to Jade at yourmoney@skynews.com.au, pass on your details, and the first 20 can go to you. So enjoy that book. It's a good bedside reading when you want to work out your investments. We'll go to a very short break. Please feel free to call us on 1300 30 34 35. Welcome back to the program. I'm Mark Todd from FIIG Securities. Tonight I'm joined by Dr. Stephen Nash from FIIG and Chris Alcott from Mason Stevens are here to answer any questions or emails. The phone number 1300 30 34 35. The email yourmoney@skynews.com.au. And just before we went to the break, I did mention this book. It is the Australian Guide to Fixed Income. It's written by the research team at FIIG, and I do recommend it. It is a great book for those people who are looking to find some ideas on the various pieces of information you need for the investment class. So feel free to email Jade at yourmoney@skynews.com.au, and the first 20 can get a book. We'll post it out to you. Keep the Australia Post in all its
Absolutely.
Mr. Fahour getting all his money. The US is the main game. It is clearly the main game. What do you think? We have a lame duck president. We have an angry Congress. We have a golfing president. We have a Fed chairman resigning, moving on. We have Yellen. We have Summers. How does it play out over the next 12 months? And I want you to tell me what you think in terms of the Yellen Summers, because I know you love Yellen.
Well, I think obviously no one knows. There's a lot of potential headwinds, and if they get it right, then we could see a continuation of what's been an enjoyable period in certainly the equities and the bond markets over the last sort of 12 months or so. However, I do think there are serious issues. We've got very strong balance sheets with US corporates. There's a lot of issuance, and there's now a lot of IPO activity. So, as I said before, I think caution is the number one. Is the best way to be positioned here, very cautiously. And our view is that certainly equities look fair to fully priced in the US. The US is facing a lot of issues. If they get them right, it could continue. But we're overdue a bit of a correction, I think.
Yellen or Summers, and Doctor, whomever it is, how significant is it to the global economy?
I think the selection of the Fed chairperson is quite important.
Correct, and thank you.
I think Yellen has got a lot of empathy with a lot of the unemployed, and she's been several of her speeches have been very interesting and really quite dovish, and I think probably the right stance to have. I think obviously very experienced and would be a great chairman. I think Summers offers a lot as well, but I think Summers is probably more interested in doing a lot more of the infrastructure development within the US. He has ideas, for example, of using a long-term issuance to fund, particularly at low rates, to fund infrastructure spending and things like that. So I think Summers is probably better suited in other roles. I mean, I think he could make a great contribution. I think either would be great. I think Summers could be prone to a few gaffes, and that could be quite volatile for the market. I think Yellen would be much more less prone to that.
Do you think, and this is to both of you, do you think it'll be a much more, if it was Summers, it'll be a much more combative experience in the Congress? Do you think that he, because of all the political baggage that he brings, do you think that the Republicans on the other side of his debates in Congress will want to come at him a little bit harder? Because I feel that there's a level of aggression around Bernanke and the like since QE, that the politicians are much more aggressive on all the public servants.
Well, I think it remains to be seen. It's difficult to try and assess those things before they've happened. We've seen some comments by Yellen more recently, whereby there was a level of frustration that whether that came directly or indirectly. Very difficult to know.
Well, you've got all these Fed chairmen that can go out, these Fed governors can go out and say whatever they like. So the people in Kansas come out and say, right, it's over, and then the guy in San Francisco said there's not enough.
Yeah.
How do you imagine Summers would manage that? Oh.
I think you've got there's always the hawkish side and the dovish side in the Fed, and some of the players have really changed sides. Like Bullard, for example, he's been quite hawkish, but recently been much more dovish and concentrating on that low inflation side. I think this is always an issue with the Fed. You always get the hawkish side always talking about this is the end of easing. We don't need low rates.
Yeah.
Where the Doves have been in control. Now, what's happening in 2014, we're going to get a switch much more towards the hawkish side. So
an aggressive,
much more hawkish than it has been this year, and we're going. And midterms are in next year as well. So the whole year will be about politics next year, and we're starting in September. So get ready for it. It's going to be a rough ride, and I think
it's going to be a rough ride. I mean, the viewers need to know that it is going to be a rough September. It's got to be. September, October are going to be kind of crazy.
Yeah.
With that craziness, we saw in June the emerging markets really suffered. I mean, there's a lot of that. There's a lot of problems around that at the moment. How do you see emerging markets at the moment?
Well, I think it's an avoid is the first point to make. I think we saw in the results from HSBC, Standard Chartered, that's having a real impact on earnings.
Yeah.
The uncertainty is enhancing that situation. So I just think for the time being, it's basically an avoid.
give it a pass. What do you think about emerging markets?
Well, it's strange you should say that. I mean, I can remember just a few months ago, everyone loved emerging markets, and you've got to be part of the emerging markets. What's happened recently is the US dollar has strengthened quite a bit, and these emerging market currencies have really been suffering. I mean, the Indian rupee has been, almost all-time lows. The Brazilian real again. The Chinese have a controlled currency, so hopefully they're controlling that. But this is really going to have an effect on, a very large part of the world's total population, and it has a big impact on regional growth as well. So I think it's quite an important thing to focus on.
And it's really interesting how the doctor's right. Everyone was on that horse. They were saying that's the best thing to be in, and then they get hurt. And it's the same as the US strategy. You've got to try and move away from that noise, don't you, to create a portfolio that says, I'm very comfortable with what I'm doing. It's the opportunity cost that I'm prepared to give up. I'm prepared to give up that upside because the volatility, I just don't know what's going to happen.
Well, I think that complexity around the currency is a good point as well, and that reduced the impact for Aussie investors certainly over the last 6-8 weeks as the Aussie also suffered. But it illustrates the point very well that there's a lot of other things to consider, not just the politics, but the currency, the underlying and climate in those countries.
Well, before we go to our next break, let's talk about the credit fund because it sort of works in well. How is your, Mason Stevens has got a credit fund. It's very, it's successful, and it meets a lot of the demands that, as I understand it, from the planner community. They like the idea that they can get in, they can get a nice ease of access. But how are you finding it? How's it all going?
Well, we launched it in June, and that was obviously a very challenging time in markets to launch anything, be it equities or bonds, fixed income related. Now, the thing about the credit fund is it looks to take out the effect of the interest rate curve, and therefore it passed its very big test, very early on in its life. So it's had a positive return over the last 6 weeks. It's up by just under 1%, and got through that initial period very well.
That's fantastic. Now we'll go to a break. I've been asked to hold the book up to show you the book. I have one request. I want all the people to email. Can you ask a question? Just don't punch in an email. It makes it a lot easier for us to feel that you're engaged as opposed to just bulk emailing us. Normally it goes the other way. We'll go to a very quick break. Please feel free to give us a call on 1300 30 34 35. Email yourmoney@skynews.com.au. We'll be right back. And welcome back to the show. If you have any questions on bond or equity markets, please feel free to pick up the phone. 1300 30 34 35 and the email yourmoney@skynews.com.au. And we'll go to our second email for the night, and the email is from a viewer from Geelong. It's James from Geelong, and he writes, "Hi, what is an asset-backed security?" Thanks. Pretty simple question. Chris, let's talk. What is an asset-backed security?
Well, it's a security that is issued with the backing of an underlying asset, being a property or equipment or a car or series of car loans, whatever it might be. So, as an example, a bank lends someone money to buy their house. You get a number of those loans together. You get the security, which is the property that's been borrowed against, and you take them off the balance sheet of the issuing institution and create a separate security known as an asset-backed security.
So when we were worried about the United States, there was the no-doc documentation for those loans, and so there were non-conforming loans, and they went to, pear-shaped. They were a mess. In that time, there are banks issuing mortgages, and they pool those mortgages and say, righto, on the performance of those mortgages, everyone's going to pay off their mortgages, and that's a residential mortgage-backed security. That's the asset, it's the mortgage, and they sell that out into the market. At the height of the GFC, people were getting, 500 over the cash rate?
At the height of the post the GFC, you subsequently, with a level of inventory available and mistrust of the sector, which I think was completely unfounded in Australia, because of what we saw in the US, there were opportunities to buy these bonds, these securities at very, very attractive prices, and we've seen them come in a little bit, but we still think there's some opportunity there.
It is the key to when we throw the baby out and the bathwater, we get rid of everything. You do see that opportunity, and maybe we'll see that over the balance of this year. Q4 might have that with that sort of volatility, everyone running for the safe haven illogically. So it could make anything. Doctor, in that environment, what's the low-hanging fruit in your mind? What do you like the look of at the moment? And bearing in mind, I won't, hold it against you, but what do you like the look of?
Well, apart from inflation-linked bonds, I like a bond, a style of bond called a zero coupon bond, issued by the Treasury.
A zero coupon bond.
But it's basically like a bank bill, a very long bank bill. So bank bills are discounted. So we use an interest rate in order to discount that $100 payment. So a zero coupon might be issued for a maturity of 2043, where the Treasury Corporation of Victoria guarantees payment of $100. And at the moment, that's pricing around $21. So for that $100, at the moment, in 2043, you're paying $21.
So I pay $21 today, and in 2043, I get $100 back.
Yep.
So I don't get any money. I just get the $100
There's
at the
actually
end.
no coupon flows throughout the life of the bond. Zero coupons are quite widely used in the US. It's quite well known, but in Australia,
That's cool. That's cool. So if I do that, how much of my portfolio do I do that in? Is the portfolio? I'll put $10 of this, or $6.
Yep.
And then I put $90 into equities, or some high yielding bonds and some equities. And this piece, this $10, becomes $100.
Yep.
That's the savings component. That's the one that effectively I put money away for a rainy day.
If you had this bond and say it was worth $23 for your whole portfolio, that gives you about $67 to spend on other assets. Now, if you had $100 for your whole super fund, and you spent this $23 on the zero coupon, that means that your $100 is basically guaranteed by the Treasury Corporation of Victoria, and you can go out and do your growth asset investing, but you will always have your $100
at the end of it.
At the end of it. So it's not a bad idea to use these bonds as a way to effectively do a DIY capital protection for your own super fund.
Yep. Any low-hanging fruit for you?
Well, I agree. I think the inflation-linked space is a standout, and as I said before, I think in the equity market, I think buy and write strategies are things that we like on the blue chips. Yeah.
Yeah. I didn't ask you at the start of the show, and I should have done, but let's chat about Mason Stevens. We had Vincent on a month ago or 6 weeks ago, and he was great. Yeah. And you've been on a few times. But for the viewers that are just new to the show, can you tell us a little bit about Mason Stevens and what your business model is?
Well, our business looks across the asset classes. So we look at the equity markets, the fixed income markets, the currency markets, and also derivatives. And we have an infrastructure whereby people can access those different asset classes in different ways, either directly through owning the underlying equity themselves or even the bond. And also we've launched things like the credit fund over the last 6 weeks, whereby we manage money through a unit trust structure and look to achieve a return of 3.5% over the cash rate in that case. So,
and you're on 23 exchanges, is that right? It's 23 exchanges and more than that, is it?
I thought it was.
How much?
96, I think.
So lots of exchanges, and you can do the foreign exchange, and you've got the Magellan. You got the Magellan. Piece is that you mirror the Magellan fund in concert with Magellan. They've built a product for you as well. Is that right?
Yes, it's a different way to access Magellan as a fund manager. They've been highly successful. Their unit trusts have done very, very well, and they've called the market exceptionally well. But if you wish to own the underlying shares that Magellan are selecting, and let's say they might buy Google or something like that in the US, then through the structure that we have, you can own those shares directly. Magellan will make the decisions as the same way they make it on the managed fund, but you'll see the individual shares.
Right, but you do it in concert with Magellan. You're
absolutely.
Working. It's not like you're trying to guess what they're doing.
We're providing the infrastructure, and they're managing the money.
Okay, well that's great. Tell me about what are you worried about? Doctor, you're a very calm individual, but what would you be worried about in terms of the investment horizon?
Look, at the moment, I think the political risk is something you've really got to think about. We've had high oil prices now for 2 or 3 months. This is really just like a tightening of monetary policy in the US. In addition to that, we've had high mortgage rates, very elevated mortgage rates.
In the US? In
the US, particularly the fixed rates, relative to what they have been. So there's a lot of headwinds there. So I think that's what is important to the outlook. I think that's what's concerning the market right now.
What about you, Chris? What are you worried about?
Well, I think the point you made earlier that how we get through the next few months is going to be critical as to how we see the landscape going forward. So the concern is really, as I said before, it's to be aware, not be alarmed, and position yourself defensively would be the view.
Do you rely on the ratings agencies for these assets now? Do you say that, okay, because I'm curious about the role that the ratings agencies play in our investment thesis at the moment. Obviously people have said the ratings agencies got it wrong and therefore there's consequences for that, people are sued. But how do you see the role of the ratings agencies at the moment?
Well, I think they provide a landscape whereby you've got an ability to compare and contrast different securities. So at their worst, that's what they do. Yet I do think they offer some genuine insight. I think, subject to what happened during the GFC, I think some of them have improved their performance, and I think they certainly play a role.
We all make mistakes. I'll talk to you about the ratings agency in a second because we have our first caller. It is Larry from the Blue Mountains in New South Wales. Larry's asking, wants to chat about a balanced fund. So, Larry?
Thank you. Thanks, gentlemen, for taking my call. I'm semi-retired. I'm semi-retired with my own superannuation fund, and I just wanted to know what is a good mix. I want to be a little bit defensive. At the moment, I'm about 75% equities and 25% term deposits, and I'm interested in getting into bonds, but I don't know enough about them. Maybe by reading that book it'll help me a bit more, but where do I find out what bonds to buy and a little bit more information?
Great. And you're more than welcome to the book. If it doesn't help you, it cures insomnia. The doctor, let's talk to you first about because it's a great question. I mean, I don't know if Larry's still on the line, but Larry, you're semi-retired. Can you give us a sense of is that a semi-retired man at 60 or is that a semi-retired man in the older?
Next week.
Beg your pardon, how old are you next week?
68 next week.
Fantastic. I hope you have a great birthday.
Thank you.
So, 68, I don't want to ask any... Larry, one of the things you do need to do is find people that you can trust and have those conversations in a more intimate manner, because I'll get an idea of your portfolio and I'll get an idea of your experience. A lot of the times you can build investments around, particularly somebody of your age, the experience you've had. And I'll give you an example. We had a client came in who had worked at Sydney Airport. He was familiar with the machinations. He knew how much money they made. So when you talk to him about buying an inflation-linked bond out of Sydney Airport, for him, he actually came in saying, I want to buy that. I've got that experience. People who work in gas, AGL, that sort of stuff, they're very familiar. So, Larry, you need to engage in that conversation. You're more than welcome to call anyone on both Mason Stevens or FIIG, but there are good people around. But at macro level, Doctor...
Yeah, look, generally we recommend, this is quite simplistic, but to own your age in bonds, so in terms of percentage. So if you were 68, you probably should have quite a high level in bonds. The problem as you get older, of course, is your horizon, in terms of your investment horizon, shortens, and your ability to recover from very severe equity volatility is reduced significantly. So we'd recommend from a macro point of view, higher level of fixed income.
So going from 25% term deposits, which is clearly going lower.
Yeah.
And the reason is not just because banks are nasty, they just don't need the money. So they're not looking to pay up for term deposits. And it's about finding the right bond mix to move that 25%, Larry, up to at least 50% that gives you the appropriate return. And within that 50%, you can move to higher levels for higher different grade bonds and get better returns. Have I summed it up quick enough for you? Because we're going to go to a break.
Very well.
Thank you, Chris. We'll have to leave it there, and we'll go to a quick break. If you have any questions, please give us a call, 1300 30 34 35, and the email, as you know, yourmoney@skynews.com.au. Welcome back to the Bonds versus Equities edition of Your Money, Your Call. We're taking calls. The phone lines are open, 1300 30 34 35. The email, yourmoney@skynews.com.au, and the emails are coming through thick and fast. We have our third email for the night. It's from Graham. Graham writes, marking the panel, there is one particular bond category that you recommend, fixed, floating or inflation linkers. A recent panellist seemed quite keen on floating rate bonds in the near to middle term. Regards, Graham from Queensland. what are you biased towards? Is it linkers? Is it fixed floating?
I'm biased to linkers probably more so because I think with the currency fall there's been some imported.
For the viewers at
inflation.
home, a linker is an inflation-linked bond we're using with my fault, sorry. So inflation-linked bonds, what your preference is?
Yes, at the moment I think, depending on the underlying bond obviously, but if you compare some of those credits, some of those companies that have issued floating rate securities and also inflation-linked securities, I think the inflation links in a lot of situations look very attractive.
And Graham, it's what Chris is talking about in terms of the yield, the return you get, is something between, let's say the benchmark is 3 3/4 to be really conservative for very safe assets, 3 3/4 up to 4.5 over the underlying CPI. So if your inflation assumptions are at 2.5 and you get 4 real, we call it, you'll get 6.5% return over the period of that bond. And those sort of returns are good returns when you consider that you're buying a safer asset. It's a more senior debt instrument, and there are lots of these bonds around because this is how infrastructure is funded. Hospitals, Spencer Street Station, the list goes on, pipelines.
Yep.
What do you like, Doctor? A fixed floating or a linker? And is that just the dumbest question I've had all night?
I just love that question.
And not you, Graham, it's me asking the doctor. He is Stephen Linker Nash.
It's got to be linkers. I think underlying exposures for all investment portfolios should have inflation exposure in terms of the underlying liabilities of the fund. Very few funds have enough inflation coverage. When you think about the cash rate at zero, basically zero real now, 2.5, basically the average inflation rate. You can go and buy these bonds at 4% real. That is getting very close to an equity return, and you're in a very senior position in the capital structure. So you're getting great risk, great return, very cheap relative value relative to floating rate notes at the moment. So yeah, inflation-linked bonds.
And I'm not saying that. I think they're the first ones you buy. You can still buy floaters that are good. I like fixed that go out to 2018, 2020, and the reason I like that is I really think interest rates will be low for a long time, and so you come down that yield curve. By the time they start to lift rates in 2016, you've got a 2 or 3 year bond. So, they're not going to lift it at the shorter end at the cash rate. They're going to lift it at the longer end, and that's where it'll affect. Mm-hmm. So I can see the benefits of both, but I'm with you. I think the linkers are the thing to go for. We'll go to another email, but I will segue into one. I've just been emailed directly to be told that the book that you're all going to now get, you'll also, as of in the next week or two, be able to download it and get the soft copy. So we'll save all the efficiencies of FIIG will come out yet again. So that's going to be fantastic. And thank you for that. The email is from Meredith. Meredith writes, I'm hearing the share market is too expensive for any investings, but have money to invest, don't really want to try bonds. Are you not recommending buying any shares? Meredith from Mulgrave. No, I'm not. I suppose the short answer is yes, you should buy shares. If you have money to invest, there's definitely shares to buy. There's no doubt about that. What are your thoughts? I can tell you your thoughts.
You can tell them. I'd be interested to hear them.
I think you made the point about the great Santos. You've just got to be able to take the time.
I think so. I still think the equity market. I don't think the equity market is horribly overvalued, and it depends on your time frame for investing. It depends on your liquidity requirements, your dividend requirements, all those sorts of things that you need to take into account. And there's certainly pockets of the market that I still think offer reasonable value. Santos, the energy space, I think, still looks quite reasonable. I think some of the stocks within the equity market look expensive relative to where they have traded historically, and so we would look to do things to try and enhance your return. Like I said, maybe buying one of the banks but selling a call option to try and reduce your entry price into that share. Yeah,
and I think, Meredith, when you see the ANZ get sold off in one day 3 and a bit %, and it's your first time buying, that might be the one that you buy, because I think ANZ will be around on Monday. I think that's an okay asset, but you need to get the right broker that could say, in the event you buy that at 3% lower, you might write an option that protects or gives you better enhancement. So there's, to your point, there's pockets around, but if you don't want to buy bonds, talk to the doctor, he'll convince you. It's only a matter of time. In terms of Meredith's email, the share market still have, that's what it is. Bond versus equities is supposed to be ironic. You should have both.
Yeah, it's a question of really how you should allocate it. It's not a question of whether you should have any equities. Obviously, there's a role for growth assets in your portfolio. You must have growth assets. What we're talking about is global best practice, and we're saying, well, looking across what other countries are doing, we seem to be very biased towards equities. You know, we had a recent call at 75% equities. That's probably pretty aggressive.
Yeah.
Now,
But by global standards.
by global standards.
Yeah.
So what we're saying is, and a lot of other people are saying this, including Ken Henry, you know, people have got too much risk in their portfolios. All we're saying is you can have too much of a good thing.
Yep. We have now Kevin who's emailed in. Kevin writes, could you tell me the advantage in purchasing inflation-linked annuity bonds? Will the real income return change over the years on the assumptions that they are held to maturity? Doctor?
Inflation-linked annuities are really very simple. People typically understand a mortgage payment. There's a little bit of principal, a little bit of interest. Basically, the annuity pays you that. And if we didn't have any inflation, we just have a flat payment which wouldn't increase. But all the inflation
So it's just like a mortgage,
yes.
Whereas you're paying the mortgage off over time, but it's in reverse.
The issuer is paying you instead of you paying
The issuer is paying you off.
So we know that. We know that's a flat payment stream. Now, all the indexed annuity does is multiply that stream by a step up with inflation. So as inflation goes up, that payment increases with inflation. In other words, you've got a little bit of principal, a little bit of interest, plus that inflation coverage. Really good product.
And the inflation's on that mortgage payment. It'll go up by whatever the inflation is.
Yes.
And the benefit of that one is the fact that at the end of the period you have all your money back, as opposed to at the end of the period the issuer owing you some money. That's why you always have to think about the credit.
Yes.
Who will pay me the money back? Is it Sydney Airport, or is it, you know, mum and dad down the road who have a real credit issue? Look, we'll go to another very quick break and we'll be right back in just a moment. Welcome back to the show. This is the last segment for the night. We have a few more emails and we will try and get through those emails next week. Unfortunately, we have another question we need to deal with. And the question we had was to talk about the hybrid market. And for everyone at home, we're not going to say the hybrid market is a bad thing. That's not the agenda. But the point is that ASIC came out this week and said they had some concerns. My interpretation of that was the way it was sold, that the institutional investors aren't buying the hybrid market. Is that your take on it, and why would ASIC be concerned about that?
Well, because it's a significant part of the funding program of the major banks, I think, is their major concern. And when you don't have institutional support sitting behind that, and you have largely the broker community, which I don't think there's anything wrong with that, but largely the equity community is selling these types of instruments, I think that's why they've raised concerns.
What about you, Doctor? What's your thoughts?
I think the new hybrids are very much a different beast to the old hybrids, because we've got a lot of conversion in the new hybrids. And what's been going on...
And now, just for the viewers at home, conversion being you're going to get equity. If in the event they have to, they'll give you equity.
Yeah, the older hybrids were much more secure than the new ones. So in terms of the institutional market, the institutions are stepping back and saying, look, we see this as quite risky, so we want a bigger spread. But the average retail investor is saying, well, I just like the yield. So they've been buying them, and the institutions haven't. I think ASIC's quite concerned about it.
And they're very familiar with the name. They buy ANZ, NAB, Westpac, CBA because they know those names, as opposed to the credit analysis that other people are placing on it. I guess, and I'm not trying to be the bad guy in this. I guess the idea is that if the equity salespeople, so the stockbrokers, are selling these products, that's all well and good. But their view is that if this gets really bad, you're going to get shares in ANZ, CBA, Westpac or NAB. That's a good thing. When the bond people would say, but you're going to get shares in those four institutions at the worst time, because that's when the share price is being... And I don't know whether that's where I see the disconnect. It's the credit that bond people apply to an asset versus the stockbrokers' experience with the organisation. They think they're safe. Is that a fair quasi-criticism?
I think it's a fair analysis. I mean, it's really a reflection of what happened in the GFC, whereby the governments around the world want to prevent that from happening, so they make sure that in the new Basel III regime that issuers of these bonds, and we've seen lots of issuance outside of the equity, the ASX as well, that that bondholders know that they can lose all of their money, or they can be converted to shares, depending on the structure that they invest in.
Yeah, and that's the common problem, though, isn't it? You are going to end up with the equity market, and Basel III has a much broader effect than everyone realises, doesn't it? It's just the idea that the banks can't lend money. Everyone thinks the banks are the bad guys, but they've met with these requirements to be more conservative by Basel III. You just can't lend the money.
Yeah, there's nothing wrong with the underlying securities. It's just the pricing of the securities. Institutional versus retail. Institutions being much more conservative.
Okay, and on that note, we will have to say goodbye. Thank you for coming onto the show, Dr. Stephen Nash from FIIG Securities and Chris Alcott from Mason Stevens, and to you, the viewers, for all those great emails and the phone calls. We much appreciate it. Until next time, I'm Mark Todd from FIIG Securities. Have a great Friday night. Go.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Every night, I give something back to my skin so it can repair itself. It's the same for my body. That's why I take Rest and Restore Night Multi before bed. Rest and Restore is different because it calms the nervous system to help you rest better, and it helps repair cells, restore energy, and replenish nutrients. So you wake up fresher and more energetic.
And there's one for us too, boys.
Restore your body with Rest and Restore Multi every night.
Look for the way. Nature's way.
Save on car insurance with Coles with Redwood.
Insure your car with Coles Comprehensive Insurance, and you can rely on Coles Insurance's national partnered repair network, whose repairs all come with a lifetime guarantee.
And so I say,
Coles' little quote.
It's a great little quote.
It's my little quote.
Save on car insurance with
Coles with Redwood.
So call or visit Coles Insurance and save with
Coles with Redwood.
Life is a journey in which we're all travelers, looking to make that great trip with someone. Journeys are made by the people you travel with.
Any real revenue.
It's tarnished. This is not glistening like it should do.
It's about the numbers.
Seen the shares up as much as 15%. We'll canvass the best economists in the business.
Commodity prices go up and down. I know that because I watch Sky Business.
We're in Singapore. The flying kangaroo far from turning its back on the Lion City.
And the bad news just keeps on coming.
Should you be looking at investment property? All right, something a little bit different.
It's good to meet you again. It's been a while.
Marius Kloppers and also incoming CEO Andrew Mackenzie.
Uncharted territory, 2.75%.
They've come out of hibernation first time since 1960.
This is Sky News Business, Australia's business channel. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Reporting season is in full swing, with the banks once again posting bumper profits, while the US economic recovery looks to be gaining momentum. But of course, dominating the headlines is the election countdown, with Joe Hockey saying superannuation contribution caps will stay low because, I quote, "I'm not going to promise something we all can't afford." We'll be discussing those stories and more in this hour. Good evening, Australia, and welcome to Your Money, Your Call Retirement. We have a bumper show for you tonight, so make sure you stick around and get involved in the conversation. Right now, the lines are open, so give us a call, 1300 30 34 35, with your questions on super, retirement and financial planning. Alternatively, feel free to email us at super@skynews.com.au for any questions on retirement, super or financial planning. My name's Sam Henderson, CEO and Senior Financial Advisor at Henderson Maxwell and author of the one-page financial plan, which is now available in all good bookshops. Now tonight, all callers will receive a free copy of my second book, the SMSF DIY Guide. Now joining me on the panel tonight are my industry experts, Liam Short from Veronte Financial Planning and Finn Kelly from Wealth Enhancers, and they are here to answer your questions. But before we jump into it tonight, let's have a look at what's happening around the country at the moment on the blue chip stocks. AMP up 9 cents today at $4.79. ANZ off 91, off 3% today at $29.45 after their bumper result. BHP off 46 at $36.87. Brambles off 8 at $9.13, and CBA off 46 cents at $73.30. Also a bumper result earlier this week. CSL off 23 at 63.35. Fortescue off 17 at 4.03. Macquarie off 52 at 44.42. NAB shares off 21 cents to 31.27, and Qantas off half a cent at $1.24.5. QBE off 18 at 16.90. Rio off $1.32 at 60.08. They had a good week this week. Stockland off 3 cents at 3.55. Suncorp off 10 at 12.35, and Telstra off Telstra even at $5.10 after a positive report earlier this week. Over to the W's now. Westpac off 34 cents at 31.26. Westfield off 14, 11.04. Wesfarmers off $1.04 at 40.22, and Woodside off 2 cents at 38.29, and Woolworths off 5 at 33.22. Now I think we have a slide on the auction clearance rates over the week. Let's have a bit of a look at that. But it has been another bumper week on auctions across the country over the last week. And I'll tell you what, if you're looking at selling a property right now in Sydney or Melbourne, I don't think you're going to have too much trouble. Melbourne clearance rate 67.3, 688 auctions, so still a bumper season down in Victoria, and spring yet to come. Auction clearance rate in Sydney, 75%, 464 auctions. So absolutely booming in Sydney at the moment. Not enough stock on the market. I know that because I sold one 3 weeks ago and I cannot find another house to live in. So lots of demand out there at the moment, particularly in Manly. Clearance rate in Queensland, 56.2, 73 auctions in Brisbane, down on volumes from last week, but up on clearance rate. So really good to see this starting to radiate across the country now, and it's really positive to see some action up in Queensland because, geez, they've had a hard time up there. So let's hope that continues with interest rates continuing to fall across the country. Tassie, 14.3, still fairly quiet down there, only 14 auctions. Adelaide, 62 auctions and 69.4% clearance rate. So plenty of action in Adelaide as well, and that was following last week, which also had a very positive session in auctions. And Perth, 14 auctions and 57% clearance rate. So very, very positive across the country, and certainly up significantly from where we started the year. And that extra 25 basis points this week has made a big, big difference across auctions. Liam, are you starting to see a lot more interest in SMSFs and property?
Yeah, look, there's a growing demand for that, and also you've got a lot of first-time buyers buying into the market, but unfortunately most of them are having to get guarantees from their parents to help with that extra 20% to avoid the LMI. And with rates where they are at the moment, that's fine, but I'm feeling in a few years' time there could be a bit of danger on the scene if we see 7s and 8s in front of mortgage rates again.
There was certainly a bit of news out today suggesting that people aren't jumping into the mortgage market simply because of the fact that interest rates are at record lows. Is now a good time to be buying? And if so, what should people be allowing for in terms of repaying their debt?
well, people need to be looking for a property that's really got good positive income on it, especially self-managed super funds, because the negative gearing is not great. 15% tax deduction on a loss is not going to make you rich in the future. So you need a property that's going to be has good growth potential, good rental income, and it is not going to need much work over the next 10 or 15 years, and you need to be able to hold it for those 10 or 15 years.
Now we have a new segment coming up called Super School, and we're going to be talking exclusively about property, and I've got a great case study to show everybody after the third or fourth segment, I think it is, in today's show. So we won't talk more about property right now, but Finn, the share market looking pretty pricey at the moment, a bit of a sell-off today as a result of what looked like some pretty good results out of ANZ. What are your thoughts?
Yeah, it definitely is getting a little bit toppy, and we've seen this sort of probably over the last year. We've been in this band between sort of 4,600 and 5,200, and every time it looks like it's about to sort of push through, something just a little bit negative comes out of America.